Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Hormuz Patakia. You know, yesterday we snapped that 3-day losing streak, saw stellar gains towards the second half of the trading sessions. But today we are not continuing that. And it also is the monthly expiry week. Tomorrow we have the expiry, the end of the month, the end of the expiry as well when it comes to the month. So interesting moves is what we're expecting ahead of that. It's been quite volatile, you have to say. Usually it's seen on the last day of that weekly expiry, but this entire week has been volatile. But for now, if you look at the Nifty, absolutely flat with some negative bias. The major underperformance, so to say, is coming in on the mid cap. So that index is down 0.3% as we speak. We did see that recovery that came by in Nifty. That happened with the mid caps as well. But overall, the market mood is towards being very quiet. If we talk about the small cap index as well, down 0.2%. And there are some sectors, the likes of Nifty CPSE, Nifty Infra, they are in the green. Of course, those big numbers from L&T, better than what the street was expecting. That's the reason that index is getting some support. We do have major movers coming in from the Nifty. So L&T, of course, is the top gainer. We have Tata Consumer as well, which is surging right now. And tomorrow is big day for results. A lot of them, Coal India, HUL, M&M, to name a few actually. So major results which are expected tomorrow, ahead of which we'll watch out for moves on these names. But that's about the big names, right? We will also spotlight on top movers in the market. Hormuz has gone ahead to that big wall to tell us all. Hormuz.
Earnings reactions continue to dominate, as you mentioned, right? The list is endless if you could take a look at the number of reactions that are moving around to the results. You start off with Nilkamal, then being the first one, came out with results last evening and has seen a negative reaction to that. And the volumes are increasing. Now, interestingly, the last 4 sessions have seen volumes in 5 digits, which is in excess of 10,000 shares. And over the last 4 trading sessions, close to 80,000 shares have been traded compared to a 20-day average of just 1,100 shares. So that is the kind of volume activity that you're seeing in Nilkamal today. The other one is Vishnu Chemicals, and that's on the positive side. It's up 12.5% today, was up 4% in yesterday's trading session as well. And take a look at the volume activity here. Just in the first 2 hours of the trading session, we have had 20 lakh shares of the stock being traded compared to a 20-day average of just 20,000 shares. And it's been a one that has delivered positive returns every single year since the end of 2019. The other one is Triveni Engineering, and that's a negative reaction today. It's down in 3 out of the last 4 trading sessions. Another 6% knocked off today. And on very heavy volumes too. 13 lakh shares have been traded compared to a 20-day average of 1.5 lakh. And it's had a good run over the last 4 to 5 years. But this year, the stock is down 25%. And this is poised to be the first negative year that the stock may have since 2018. And lastly, an example of a wealth destroyer, New India Assurance. The stock is up 8.5% today, but don't get fooled by that. It's still down 8% on a year-to-date basis. It listed in 2017, and with the exception of 2023, the stock has delivered negative annual returns every single year. The stock is at 188. The IPO price is 800 rupees a share. So a positive reaction today for New India Assurance, but the broader markets, though, are veering towards the negative side.
Oh, they are. It was such an interesting list, Hormuz. Thank you so much for bringing us that data. So those are some broader market movers that we are talking about. But let's talk about a new entrant on D Street. IndiQube Spaces made its D Street debut today with a discount at a discount. The listing price was 216 rupees versus issue price of 237 rupees per share. The company provides managed workplace solution and has a strong presence in Bengaluru and 13 other cities. To discuss more on this, Rishi Das, who is the chairman, executive director and CEO at the company, is joining us now. Rishi, good morning. Thank you so much for joining in. Now that you are listed, you can give us more sense of what the broader market picture and the future growth is looking like. You have seen a 35% revenue CAGR over the last few years. Is this something you will be able to continue going forward? And while we talk about the top line, bottom line is something that investors want to know more about. As per the PNL, when will you get into black?
So, thank you so much, first of all, giving me the opportunity to come here. And I think our sector has been growing very well, and the industry has been growing at least 20-25% year on year. And if you look at the CBRE forecast for the next 2-3 years, that looks likely that this will grow at that. and we have been growing better than the industry average. So we have every reason to believe that we should be having good, robust growth in the coming time. Plus, I will also like to emphasize that we have almost 33% of the space that we will be occupying over the next 6 to 18 months. And that portfolio should allow us to have a lot of headroom for growth. And overall, I think we should see great performance coming forward, yeah.
And what about the bottom line? You said you're profitable when it comes to a different accounting standard, but
Yes.
with what you report, with those accounting standards, by when will you be seeing a green, black on the profitability?
Yeah, so very difficult to put a number to that, as you can imagine. But yeah, like because a lot of our properties are on long leases, and typically what we have seen for a given lease, basically like after 8th or 9th year, if it's a 20-year lease, the accounting, as per the accounting standard of Ind AS, the tides turn. And since we have a good portfolio, which is now almost like more than 5 years old, and we continue to grow. So I think in the foreseeable future, we should turn it. But if one were to look at like year 23, we have paid income tax. Year 24, year 25, we have paid income tax. So we have been PAT positive all these years typically. So I think it's more and like that's what as per our roadshows also we have tried to explain to investors that how and what is the right metric. And as we will be releasing our results, we will be providing investors with the comparative on both the accounting standards, so provide them more clarity. So we are very healthy at EBITDA level. Our unit economics metrics, if you look at our occupancy, is north of 85%, which is very, very good in our industry. So I think all that points to that we are building out a very sustainable, robust growth engine. And that's, to be honest with you, that should not be a worry for any investor, what you are seeing as per the accounting standard, a loss kind of a thing.
Rishi, congratulations firstly on your listing. You're now a public company, so well, you will be asked for numbers. And, geographic concentration is one thing that has been off note in your numbers. 60, almost 2/3 of your revenue comes from Bengaluru. Are there plans to diversify to other major office markets of the country? And what are the plans on the annual for this year?
So we are diversifying. If you see, like a year back, we were just in about 10, 11 cities. Now we are 15 cities. So we are growing. And if you look at, of course, Bangalore is the largest market. And if you are aware, like 30% of the real estate that India absorbs annually just gets absorbed in Bangalore. And Bangalore absorbs perhaps the most amount of real estate as a city anywhere in the world. So definitely we have a pivot towards Bangalore. We see that more as a strength. Having said that, if you look at a city like Chennai, we have almost 1.5 million square feet of space now, followed by Pune. We are going very fast in Coimbatore and a lot of other tier 2 cities. So going forward, see what is happening is that we have to appreciate the fact that work is going where people are. Not the other way, like my generation went where work was. So I think that shift is a very secular trend. And IndiQube clearly is looking at riding that wave and trying to expand within cities and in a lot of tier 2 cities as well as we grow.
Okay. Rishi, what is the revenue per square feet currently? What has been the growth so far? And what will the levers be for growth from here on, apart from adding the portfolio that you have been talking about? 8.3 million square feet will be the total asset under management. Will you look at some places with higher margins, any premium places or spaces that you'll be offering to clients?
So we have a very healthy mix of office spaces. If you see, as you rightly said, out of 8.3 million square feet of portfolio, 6.3 million of portfolio is operational. And we have a good headroom of more than 2 million square feet that is going to get added over, as I told you, over 6 to 18 months. So there is quite a good growth potential that we are likely to see. Sorry, I forget the second part of the question. Just can you repeat?
No, I wanted to understand what has the revenue per square feet been? How much has it grown?
Yeah. So I can tell you in terms of seat, like typically we market seats in locations like Outer Ring Road, kind of locations in Bangalore between 8,000 to 9,000 rupees a seat. And a seat for us is about 45 square feet on an average. So if you go by that logic, about 180 to 200 rupees is our revenue realization per square foot. That's what we realize, yeah.
All right, Rishi, thank you so much for sparing time joining us. Congratulations once again on your listing, and we hope to chat with you once you come out with your numbers as well. The management of IndiQube, the second listing of the day. The stock listed at a discount is slightly extending its losses now, 11% lower now compared to its issue price of 237. The other one though, GNG, listed at a 50% premium, still holding on to gains of around 43 to 44%. Take a short break here on Trading Hour. All things commodities on the other side with Manisha Gupta. Welcome back. All things commodities now. Manisha Gupta is here with us, and to put the spotlight on crude that is being on the boil yet again. $72 plus now for Brent, Manisha.
Oh, well, absolutely, yes, Hormuz. It was 2% of gains on Monday, 3% up on Tuesday, and we are holding at $72 a barrel right now. If you look at the last 1 week, we've seen prices gain up by 6%. And for the month of July, the crude oil prices are now 8% on the higher side. It's trading at a 5-week highs as well. And there are various factors supporting the markets. One, it has to do with improvement in the global trade sentiment, with so many trade agreements being signed and more perhaps on table with some timelines coming in. This tells you that the economies will do better, and the global economic growth, or rather global demand growth for crude, perhaps could be in the supportive side there. Second important part really comes in from Russia, where Trump has now said that he's giving them 10 days to agree on ceasefire or perhaps face secondary sanctions. Now, we already have seen European Union put an 18th package of sanctions on Russia, and the 18th package mostly was on oil and gas and energy in sense of Russia there. There also is a corresponding statement coming in from the U.S. Treasury Besant saying that if the sanctions do come in on Russia and the deal with China until then is not done, then China could perhaps be sanctioned as well for buying Russian oil. So various statements going around, and that clearly seems to be supportive for the prices there. Apart from that, it also has to do with the OPEC Plus statement, where they say, or the conversations within, that after increasing output from the month of May until September, October could be a month of pause. That has been supportive. But in focus clearly is the PMI data from China that comes in tomorrow. It also is going to be the Bank of Japan monetary policy meeting. That is tomorrow. And today you have the US Fed meeting. So the next 24, 48 hours are going to be quite eventful, and that is where the markets will take cues from.
All right, so that's all about crude oil prices at 5-week highs. Thank you so much, Manisha, for joining us as always and telling us what's happening in the world of commodities. A reminder for our viewers now, though, unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, a premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back. You're still tuned into Trading Hour. It's a good time to get a technical check on the markets. Mitesh Thakkar is joining us now for just that. Mitesh, good morning. Thank you for joining in. What's your take? What would be the next important level? We are seeing a lot of volatility, that recovery that came by, then it's getting sold into. What are the charts suggesting?
So, my belief is that, the immediate downside may be capped, limited to about 24, 500, 550 zones. And because we haven't got a very strong reversal sign, I think on the upside also, it could be a range of about 25, 250 thereabouts. It looks like basically the market could be starting a new range between this 24, 550 odd levels to about 25, 250 odd levels. So that's the kind of outlook on the index. On the stock side, though, I have a buy on CESC Limited, which is capital electricity. Keep a stop at about 176 and, look for a target of around 180. And the other one is Bank of India. Target of 182. And the other one is Bank of India, which I would recommend buying with a stop at 114, targets of 120 plus.
All right, Mitesh, thank you for joining in with your views on the index and on specific stocks as well. But there has been a very sharp recovery over the last few minutes. So it's good time to go across to Mangalam to see if there has been any dramatic shift in the F&O data. Mangalam.
Well, there hasn't been a dramatic shift in the F&O data, but the fact that there was an uptick which was imminent was visible yesterday as well. The question is whether we go ahead and, regain that momentum as we move towards expiry, or do we just consolidate at lower levels, or after having seen that up move yesterday itself, consolidate at current levels or not. So you look at the Nifty Bank as well as the mid-cap index. The mid-cap index is slightly lower, even as the Nifty is hovering closer to that 24,900 mark. The 24,900 call writers, they're still not facing the jitters. In fact, they're constantly writing more options out there. So 24,900 call is something that I'm definitely watching out for. If the market sustains above that 24,950 mark for a bit, then these call writers will have to cover their positions, and a move similar to what we saw in yesterday's trading session may take place. But until then, we are looking at just some consolidation. The 24,850 call writers, they're also fairly active for a premium of 90 rupees, telling you again that, around 24,940 to 24,950, there is some supply which is likely. However, what this up move has definitely done is given confidence to people to go ahead and write the 24,800 put, telling you that the support for the market has moved higher. Yesterday's low was just around the 24,600 mark, but today that's moved higher to around 24,650, 24,700, because that's where we've seen a lot of put writing at 24,800, and the premium out there tells you between 24,700 and 24,750 there is support. So broad range, 24,750 on the lower side for the Nifty, on the way up until 24,950 is taken out considerably. We can't expect further short covering. So that's the broad, consolidation that the index is likely to face. But a couple of stocks, they are on our radar. L&T continues to do well from yesterday. Yesterday, the up move was ahead of numbers on the back of an order win, and now order inflows are strong. So a lot of long positions being added on L&T as we speak, and that's also taken the Nifty higher. And the second stock I'm looking at is Tata Motors, because, ever since the start of trade, it's been under pressure on, on the news of a potential acquisition. The company has not come out with any clarification, but the street has taken a lot of short positions and on that counter ahead of that news itself. So were that news to come by, it will be very interesting to see whether those shorts unwind their positions or not.
Okay, yes, there's a lot of news flow as well on Tata Motors. Thank you so much, Mangalam, for joining in with that F&O update. By the way, the surge that we're seeing from the lows on Nifty is coming because of Reliance Industries and Infosys as well. Both these stocks have recovered from the lows of the day, and they are supporting the Nifty from the lows. So watch out for that one. There's a major recovery that we're seeing in the markets currently. But you have to remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour, and it's all about IPOs now. Let's talk about Sri Lotus Developers in Realty. The company is eyeing D-Street debut. The IPO has opened today, will end on August 1st. The IPO size is nearly 800 crore rupees, issue price between 140 to 150 rupees per share. Anand Kamalnayan Pandit, who is the chairman and managing director, along with Sanjay Jain, who is the CEO at Sri Lotus Developers and Realty, is joining us now to discuss more and to understand about the company as well. Gentlemen, thank you so much for joining us today.
Thank you for having us.
93% of your total projects come in from redevelopment, and only 7% is coming from greenfield development. Tell us, how does accounting work here? Because usually when we talk to real estate players, it's more about how are the bookings going on. How does redevelopment differ from that? And what is the margin differential that you earn versus, say, a greenfield project that you will be coming up with?
Sure. So first of all, I'll introduce my company. We are in a micro market of Mumbai, operating in luxury and ultra luxury space, and that also in the redevelopment space. In generally redevelopment space, people are in aspirational or premium category. We are in luxury and super luxury. So when it comes to redevelopment of societies, as we know, we don't have to pay for land. That's the main hurdle or advantage, I would say, in our case. Also, second advantage, we are not carrying much issues with legal because their buildings or societies are standing there since many years. So these are the two major advantages what we are having. And otherwise, when you take a greenfield project or maybe a land, then you run a risk of title maybe at some time or maybe some approval issues. Here, we don't find that. So because of that, and also since all these societies are generally have taken away those prime land in the locations. So all those prime land we can get. So these are the advantages for us, and also our sale becomes easy because society old tenants who come back to the society, they generally need more extra space or more apartments or more office space. So I would say about 10 to 20% our material is sold to them. The model is we go to society, old societies, we make the partnership with them, we remove their whole building, we make a tall high-rise building, and percentage of that, generally about 35 to 40% of that new building, we give them back. And remaining portion we use for our recovering our cost and make the profit out of it.
Okay.
So that is why, we are like a net debt-free company. We don't need debt. Even up to the extent that we have got 300 crore fixed deposit as on 31st March, which is very unlikely with the real estate company. So we are slotting our company, not a hardcore real estate company. We are, I could say, we are more like a specialty chemical company rather than a chemical company. And we are like a product company in real estate space. So we make product, we make a high-end product, fully loaded product. And we complete all our projects faster, 2.5, 3 years. And that is how our business model is.
Gentlemen, thank you for joining in. Congratulations on your IPO as well. You have a major concentration towards the western suburbs, right? But now with the western suburbs being the way they are, and the eastern suburbs, particularly Thane and all those areas coming up as rapidly as they are, have you thought of moving towards those areas as well? Because the demand for more than premium housing or more than entry-level housing has increased even in those areas.
Yeah, as I said, we are more in luxury and uber luxury space. So we are right now concentrating on western part, and now we have entered into town also. And our philosophy is that we want to take one micro market, and which are micro market which offers at least 50 to 60,000 square feet per square feet kind of pricing. Only those markets we are moving right now. And we don't have to, we have no marketing. We have never done any marketing. We have never advertised. Maybe probably first time in my life we have advertised today because our IPO is open and we have to give that mandatory advertisement. Otherwise, no advertisement, no hoardings, no social media marketing. We have never done any printing of even brochures. No big launches. So what we do is we focus on our high-end product and on customer and customer service. So slowly, every micro market we establish ourselves, we get those kind of premiums and move forward. Yes, answering your question, yes, tomorrow if we find a potential in other micro markets like eastern suburb Thane, we'll be more than happy to move there. Since we are an asset-light model, we are completely asset-light model, except one project, which is 7% constitutes of our total portfolio. We don't have any land. So because of that true asset-light model, we are that flexible, we can go anywhere, any micro market.
So, I was looking at your numbers now. Since you do not have an accounting issue, I believe you do not go the completion method. It's as per the stages, right? As per the P&L. EBITDA margins at FY23 were 12.8%, moved to 52.6% in FY25. Is it the right way to look at those margins, and will you be able to maintain these numbers? Because that's a sharp surge that we're seeing now.
So we are following the percentage completion method. So in 23, 24, 25, the average sale price is increased. And because of that, the EBITDA margin is much higher. And we are continuing on all the other projects we have taken. We are aiming the same margin can be achieved. So
it'll be around 52% is what you're saying, even going forward?
We are thinking about that. So we can achieve the same margin.
So your square foot per square foot pricing will be around 50 to 60,000 going forward?
Right now, depending on the project, because commercial and residential, both we have got projects. So depending on the project, depending on where we are located, it's between 45,000 to 65,000. That's the price range we are working on.
Now we have 13 projects that are listed for execution, if I get that number correctly, compared to awaiting approvals. In those projects, what kind of revenue recognition are you expecting, and by when do you start recognizing revenue from those projects?
So total 16 project is, so 5 is upcoming, 5 is ongoing and 11 is upcoming, out of which 7 project that will be around estimated sale of 7 lakh square feet will be launched in the current year, and the total balance 12 lakh will be launched next year. So that is the total gross development.
Okay, so what is the idea on growth then when you're looking at higher square foot projects going forward? So the top line, what kind of growth are you expecting there? And in terms of, since you're an asset-light model, so you won't be looking at a lot of capex, the pipeline will be asset-free. So what is the plan with the cash that you have? Will you be giving it out as dividends? Will you be reinvesting it back in the business? Because it won't be requiring that kind of reinvestment as well, since you're just taking buildings and redeveloping them.
Yeah, so 2 separate things. One is taking care of our investors. Yes. At the appropriate time, we'll take that decision, how to share those prosperity with existing investors. And as far as our proceed is concerned or our profit is concerned, yes, we will be plowing back into the business because we want to grow this business. Since last 6-7 years, we have done many redevelopment projects in ultra-luxury category, and that model has proved very robust and very solid. And according to one report, almost 30,000 buildings or societies are about to go for redevelopment. So we have got a huge market which is ahead for us, you know.
Okay. Fair to say that from 560 crores in FY25, you would go up to say 900 or 1,000 in the next 3 years?
Difficult to say that, forward looking, you know.
Yes.
But whenever, after listing, when we'll come here, we'll give you the guidance.
We'll get all the numbers from you.
We'll give you the guidance. And we are a very unique company. We do not have any RERA case also. As I said, technically we are net debt free. We don't have even a RERA case. Our ROE is very high. Our EBITDA margin is also very high. And we do very fast execution. And because of that, you know, that brand equity we have built, that in luxury space, we make projects very fast.
Got it. Makes sense. And we understand compliance issues, so you can't give us forward-looking statements. But definitely, we'll ask you all of that once the stock is listed as well. Thank you so much, gentlemen, for joining us today and telling us about your company. That's about Sri Lotus Developers and Realty. The company is largely into redevelopment, most of it, 93%. So interesting business model there. Time for a short break now. Management of Allied Blenders will join us next to discuss their Q1 numbers and more. Stay tuned for that.
Welcome back. In conversation now with the management of Allied Blenders. Alok Gupta, who's the managing director, is joining in to discuss the road ahead for the company and the quarter gone by. Alok, good morning. Thank you for joining in. You know, your premium and above segment has done very well this quarter. It's been a strong start to the year. 55% of your top line came from this segment. Majority of your volumes came from this segment. what is the kind of mix that you envisage for the full year and the kind of growth that you are anticipating for this segment in FY26?
Thank you for inviting me and for the performance on the P&A segment. We are targeting P&A to contribute to about 50% of our overall sales. FY24, we were at 37%. So over the last 4 quarters, we are already at 46 in Q1 of this financial year. So we are targeting to get the P&A salience to go up to 50. The value share from P&A is already up to 55%. And they should further consolidate about 60% of the revenue coming from the P&A segment.
Okay, and what kind of growth will you look at in FY26 from the P&A segment?
We are hopeful to target a double-digit growth from the P&A segment. We've already seen in Q1 a growth of 44% coming in, but overall we are looking at high double-digit growth coming from P&A.
Okay. Alok, a large deal happened in the space recently with Tilak Nagar making that acquisition. Do you think there'll be more competition in this space? And what kind of market share are you seeing in some of your major brands?
Well, I think it's not my place to comment on the competition. If I was to see it through a consumer lens, consumers prefer one brand over the other. So eventually, we believe it's a high-cost acquisition. Therefore, we believe there will be discipline in terms of how the brand is taken to the market. So eventually, the war will be fought with the consumer. Who wins the consumer gets the market. From a market share perspective, in the prestige whiskey segment, we have 3 brands, which is OC Blue, Iconic, and Sterling Reserve B7. Iconic continues to be our growth engine. We did 5.7 million cases last year, and it has got a very strong ARR. And we are seeing buoyancy in other 2 brands. So we'll continue to acquire market share. So the battle has to be fought with the consumer. That's all I would say.
Alok, there were recent developments, right, with the Mansion House launch and the Savoy Club Spirit brands, where the Bombay High Court had restrained you from doing so and had ruled in favor of Tilak Nagar Industries. What's the future course of action that you plan on taking in this regard?
The matter is sub judice, so unfortunately, I cannot provide more color to it. But needless to say, the projections that I've shared in terms of either our volume growth or on our gross margin or on the forward EBITDA does not factor any future gain that may or may not come from these 2 brands. So our entire plan is independent of these 2 brands.
Okay, got it. So there's no indication on by when there'll be final decision on this?
Like I said, unfortunately, cannot provide you color on this.
Got it. Any clarity on the net impact of Maharashtra excise duty impact? It is less than 10% of your overall volumes, but you had indicated there could be some changes. What's the final take?
Well, the final take can only emerge once we have a clarity on the MML policy, which is yet to be announced. The only thing that has been announced so far is the excise duty that will be applicable to MML. But the final contours are yet to come through. So until unless we do not have full clarity on MML, forming a view is difficult.
Now that we have done with the first quarter and it's been a very healthy start to it, Alok, what are your realization targets that you have set for this year and your volume growth target as well for the overall business?
So I think 4 broad themes that we have spoken about consistently over the last 4 quarters continue to focus on profitable growth. We're looking at a double-digit volume growth and a mid-double-digit value growth coming on back of solid P&A performance. We'll continue to focus on gross margin improvement through 3 basic means, which is focus on cost. So far, the environment has been neutral to positive. The FTA would be a big boost to our margins. So we are hopeful that in this financial year, maybe by Q4, we'll get final controls on implementation of the FTA. And third really is the investment that we made in our backward integration program, which is in moving our ENA capacity from 1/3 to 70% on back of acquisition did in Maharashtra, the malt plant and PET. We are looking at gross margins to improve further. And therefore, we should see EBITDA equal or higher than the Q1. But more importantly, the overall borrowing is down. And we have also been able to correct our borrowing rates on back of 2 re-ratings that we have done. We are now A with positive rating. So we see a positive impact on net retained margin on PAT. So that really is the commentary on how I see the next 3 quarters.
All right, that's a clear picture. Thank you so much, Alok, for joining in today and telling us what the plans are going forward and what will be the growth levers for the company as well. Time for a short break now. We'll get you more on the markets on the other side of this short break. Stay tuned.
Welcome back. Interestingly, today's intraday high for the Nifty is 24,902. So we crossed yesterday's high and we crossed Monday's high as well. But as has been the case over the last few sessions, the index has failed to hold on to elevated levels. It'll be interesting to see if the second half brings about a bit of a turnaround in today's trade. But of course, there are a lot of movers though. Five-Star Business Finance recovered from the lows yesterday, but it's still down almost 4% in today's trading session. Zen Technologies is locked in yet another lower circuit today. So not good going for Zen Technology, seeing some profit booking from elevated levels. Siaram Silk Mills is down 5% as well, as is Shankara Building Products. There are some names that are bucking the trend as well. We've spoken a lot about the losers. Take a look at Bliss GVS Pharma. That stock is up 16% as the top gainer on the BSE Small Cap Index today at the highest point of the day. And just as we speak, earnings have started to trickle in for the day. You have Nesco's numbers flashing at the bottom of your screen, a 37% jump in its revenue, a 28% jump in its EBITDA, and take a look at the spike that the stock has seen, 6.5%.
We keep seeing those boards outside Nesco, right? This exhibition, that exhibition. So I think that is something which can be seen in the numbers.
If you visit Nesco now, the amount of eateries that have come up in Nesco is unbelievable. The number of eateries that have come up there, and more are coming up as well. So the number showing in the numbers as well for Nesco, sharp surge in revenue as well as its EBITDA, and 6.5% higher on that stock as well. Take your leave on this edition of Trading Hour from Sonal and me. Thank you for watching. Halftime report on the other side.